Hello students, you are here today because you are doing an end of year revision for Chapter 9 Inventories. What do you need to know about Chapter 9 Inventories? You will need to know the theory, all the theories related to inventories, like the definition of inventories, the accounting theory. You will also need to know how to record the purchase of inventory in a ledger and how to impair inventories. So this is an example of question 1. This business, called Jerry Trading, sells luxury sandals in Orchard Point, and they use the first in, first out method to account for its goods sold. There's a whole lot of information in front, but the first few questions, if you notice, is actually more about the theory relating to inventory. So the first one, the valuation rule for inventory. Now, what is the valuation rule for inventory? Okay, at this point in time, you need to recall that inventory is valued at the lower of cost or net realizable value. What does it mean? It means that if the cost, let's say for example, if the cost is $1,000 and the net realizable value, which is how much it can be sold, is $1,200, then you should value it at the cost price, $1,000. However, if your cost is $1,000 and your net realizable value, which is how much you can sell it for, is about $800, then you should record it at the net realizable value, $800. It means that in this case, you purchase the inventory at a cost of $1,000, but you can only sell it at $800. You have made a loss. And when you make this loss, you need to recognize the loss immediately. You will also need to reduce the cost of your inventory. All right, so that is what you are required to do. For the sake of the answer, you only need to say that inventory is valued at the lower of cost or net realizable value, whichever amount is lower. Now, why do you need to do this? Why do you need to value it at the lower of cost or the net realizable value? What is the accounting theory that you are following in this case? The accounting theory that you are following is called the prudence theory. Now, what is the prudence theory? The prudence theory is basically saying that you cannot overstate assets or profits, and you cannot understate liabilities or losses. What does cannot overstate asset or profit mean? It means that if your assets are only worth $800, you cannot say that it's worth $1,000. You cannot give a higher value than what it really is worth. Or if you earn the profit of only $800, you cannot say that you earn a profit of $1,000. That is overstating your profit. You're saying you earn a higher profit than what you actually really earned. Next, what does cannot understate liability or losses mean? In this case, it means that you cannot say that you have lesser liabilities than you really have. For example, if you owe somebody $1,000, you cannot say that, oh, I only owe the person $800. That's not right, because you owe that person more. In the same way, you cannot understate your losses. If you have already made a loss of $200 because your inventory loss value of $200, you cannot say that, oh, I didn't make any loss at all. That is understating your loss. So the prudence theory says that you cannot overstate your assets, you cannot overstate inventory, and you cannot understate liability or losses. You cannot understate impairment loss on inventory. Next, they want you to state the source document that you have received from Jason Brothers on 18th of May 2021. Let's see what happened on 18th of May. So basically, you bought on May the 16th, you bought some inventory from Jason Brothers. And on May the 18th, you return all of the goods to Jason Brothers because they were of the wrong specification. Maybe you ordered green, but red arrived. We hate red, so we're going to return it to Jason Brothers. So what is the source document that you would receive from Jason Brothers? Now, because originally you purchased some goods on credit, when you purchase goods on credit, the source document is invoice. And then after that, you return all of these goods to Jason Brothers on credit. You haven't paid them yet. So Jason Brothers would issue you a credit note. Right? You would receive a credit note from Jason Brothers. So the answer is the source document that you receive from Jason Brothers is a credit note. Because the transaction is on credit, it's not yet paid. Right? So what are we asked to do next? We are asked to prepare the inventory account to record all the transactions in May 2021. Let's take a look. Well, actually, there are a lot of transactions, right? So we're going to break down these transactions and record them one at a time.